Hello, I'm Russ Mould, AJ Bell's Investment Director, and welcome to Fundamentals, our regular look at the world of funds and collectives, where we highlight one of the most popular purchases on the AJ Bell Invest Centre platform, and then analyse why advisors and clients might be buying right now. This week, 7th on the list for passively run funds is Vanguard's FTSE Japan Equity ETF, or Exchange Traded Fund. An ETF is designed to track, mirror the performance of the underlying assets and deliver that performance minus any running costs. Now in this case, Vanguard FTSE Japan Equity uses physical or direct replication, so it owns the underlying securities, which here are Japan's leading large and mid-cap stocks. The fund has 478 positions and the holdings have an average market cap of a shade under $15 billion US. The top 5 positions are car makers Toyota and Honda, and giant banking and finance groups Mitsubishi UFJ, Sumitomo Mitsui, and Mizuho. Now the ETF comes with an ongoing charge figure, or OCF, of just 0.19%, so it's pretty cost effective. According to data from Morningstar, only products from DBX Trackers and Amundi come with lower OCFs out of a field of 31 options. For the record, the only OICs that come in cheaper than Vanguard FTSE Japan Equity are themselves tracker funds, while the lowest OCF for an equivalent investment trust is 0.98%. Now this first chart shows how the Vanguard FTSE Japan Equity ETF has done since inception in May 2013. Note, it's priced in sterling. Okay, that's the mechanics out of the way. The next question is, why would advisors and clients be looking potentially at Japan right now? I think there are 3 possible answers. First, it's Abenomics, the wide-ranging reform programme championed by Prime Minister Shinzo Abe and designed to kickstart Japan's debt-laden economy after nearly 25 years of deflation and stagnation. November's successful Japan Post initial public offering is just the latest leg of the plan. The second possibility is monetary policy. There is talk that Central Bank Governor Haruhiko Kuroda may raise the size of Japan's quantitative easing scheme again fairly soon, even though it's already running at 80 trillion yen a year, equivalent of 16% of GDP. The third possible attraction, well, that's valuation. Tim Price of PFP Group helpfully points out in his weekly blog that roughly 70% of the US equity market trades on a price-to-book ratio above 2. Roughly 40% of the Japanese market trades on less than 1 times book. In addition, Japanese firms are cash rich, with north of 200 trillion yen, 1.8 trillion US dollars, tucked away, so advisors and clients who do buy stock or get a look for exposure may at least get some degree of protection on the downside should something go wrong from that cash. Now, of course, something could go wrong, because there is a bear case to Japan of which we should all be aware. Remember, the country's debt-fueled equity and property bubble popped in 1989, and the stock market has never come close to recapturing its all-time highs near the 39,000 mark. As I sit here today, the Nikkei benchmark trades at just under 19,000, barely half as much. Here lies the rub. Japan does have some serious fundamental economic problems. A sovereign debt pile that equates to nearly 250% of GDP, a sum that makes Greece's liabilities look small, and an ageing and shrinking population for it to tax and try and reduce the burden. In addition, Abenomics is yet to sustainably drive economic growth or inflation higher. This chart here shows year-on-year growth in GDP on a quarterly basis. The next, the monthly inflation figure, still again somewhere below the 2% target. Abenomics, therefore, you can argue is working for the stock market, which has more than doubled since Abe took power, but it's yet to prove itself for the real economy. And remember, Japan's had 0 interest rates since 1995 and ran QE between 2001 and 2006. As soon as stimulus was withdrawn, the economy, inflation, stock market all rolled over. Japan's therefore fascinating in its own right, but also has interest as a potential case study for how QE could play out in the UK, US and Europe. Thank you for watching, and I look forward to seeing you next time.